So this is part number 37 of this multi-part video series for positional stock traders. One of my YouTube subscribers, he is a programmer and he looked at the filter that I have created for positional stock trading and he gave me an idea to save time. Now, as you know, I am an old school guy. I do things manually. I just put the basic filters and I look at each stock that comes in that filter literally manually. And that gives me a feel of the market. So, whenever any student of mine gives me an automation idea, I don't get very much excited because I like the old school way of hunting for stocks. I like to do it manually. It gives me a feel of the market. I trade based on my instinct or how I feel. Of course, I use filters. Of course, I do liquidity analysis, comparative analysis, technical, fundamental, and market analysis. But your instinct, your experience, your knowledge can be used to make the final judgment call. That is my approach. Having said that, if programming or automation is done with the right intention to save time and in good spirit, I think it's a good idea. So let's first look at the filter and then I will discuss the idea that he gave me. And I found one weakness in that idea, which I would like to discuss with you. So this is more of a discussion we are doing on filters because risk management is also directly related to filters. As I discussed with you in one of the prior videos in this series, the more tighter your filters are, the lesser is the risk you are taking. The more lenient your filters are, the more the risk that you are taking. Okay. So let's first look at the filters that we are using. So this is just a second. I will remove that filter. So our first filter is the relative strength of the stock should be more than or equal to 70. The institutional demand should be A or B. The industry group rank should be less than or equal to 100. Relative strength I prefer more than 80. Okay, although here I have mentioned 70. Buyer demand I prefer to be A. Industry group rank I prefer to be less than or equal to 40 and increasing. Technical filters price greater than or equal to 20. Average rupee volume more than or equal to 1 crore. This is to avoid penny stocks. Average daily volume, this is a negotiable criteria. Average daily volume should be more than or equal to 200,000 shares traded. Then price should not be more than 25% below the 52-week high, or price should be within 25% from the 52-week high. Price should be at least 25% above the 52-week low. Then the price should be above the 50-day and the 200-day. And the latest quarter sales growth should be minimum double digit. The latest quarter EPS growth should be more than 18%. This is consistent with what is given in books written by Mark Minervini and William O'Neill. So this is a very evergreen filter. You can use this filter both for positional and swing trading. For swing trading, you can remove the two fundamental filters. Whatever stocks you get, they may or may not be fundamentally strong, but if they set up well technically, then those can be called as swing stocks. Now, if I apply this filter, see how many stocks we get. So we are getting 89 stocks as of end of today's market close. Now this list consists of 4 different kinds of stocks. Okay. Before that, let me show you a chart. This is Mazgao doc. As per SEBI regulations, we are using the old chart. So this is May 2023, couple of years ago. Okay. So nice cup with handle. So the high of this candle becomes the pivot point, which is 413.70. So I'm just going to draw the pivot range. I'm not going to draw the green selling range. I'm not going to draw the red stop loss range because I want to keep your focus on the pivot range in this particular video. So let's do that. It's already blue color, so it is 413.70, 413.70, and this is 5% above that. So I will take out my calculator. See, I keep telling you I am an old school guy. Look at this calculator. That's a Casio calculator. That's called pure old school manual way of doing things. Okay. So 413.70 multiplied by 1.05, 434.38. Some of you programmers must be laughing at me. A lot of my students are software programmers, coders. Some also understand artificial intelligence. So please don't laugh at me. This is my crude way of doing analysis, because see, I have told you earlier that if you want to become a professional stock trader, software programming or coding is not a required skill. For example, if you want to become a marathon runner, to become a good marathon runner, you don't need to be a good cook. Cooking is not a skill required to become a marathon runner. Or if you want to become a good software programmer, cooking is not a required skill. You don't need to know how to cook to become a software programmer. So these two are unrelated skills. Similarly, to become a professional stock trader, you don't need to know how to code. I don't know anything about coding. People write something called as Pine script. In TradingView, there is something called as Pine script. You can code and you can put things on the chart which come automatically. So a lot of my students, my subscribers have taken my system, automated it completely. And whatever I am doing here manually, they do it automatically. It probably automatically shows everything on the chart. Maybe they pull data from MarketSmith website. I don't know how they do it. Somebody told me about something called as API. God knows what is API. I have no idea what is API. But he says that he is using API to pull data from websites and get it on TradingView. God knows what he's doing, but whatever he is doing, he knows what he's doing. I don't know what he's doing. But this is my method. Okay, just look at the chart visually and take a decision. Okay, it's very simple. Okay, and I do this every day, by the way. So if you look at 89 stocks in positional, in swing, I'm getting 165. So 165 plus 89, 254 stocks is something that I am tracking on a daily basis manually. I manually open these windows in different windows on different tabs here. 254 stocks. I am doing it daily. Imagine 254 multiplied by 5, 1270 stocks I am scanning on a weekly basis. Now you might say, Rohit, there is an overlap between the swing and the positional. All positional stocks are already in the swing filter, right? I agree, but in when I'm scanning the positional list, I'm looking at the weekly chart. When I'm scanning the swing list, I'm looking at the daily chart. There I might find positional trades on the daily chart. But overall, if you see, I'm looking at 254 charts in a single day. That gives me a real feel of the market. If I were to use automation, I would never get that feel, right? So that's why I like the old school method. Coming back to our discussion. So this list consists of 4 different types of stocks. The first type of stock is the stock that has already broken and gone above the pivot. So let's say there is a stock which has broken this pivot point and it's gone 15% above the pivot. That's the first category of stocks in that list. And that is mentioned in blue color on the top right corner of the MarketSmith chart. Correct? I have explained this in one of my videos in this series. So these are stocks that have already broken above the pivot. Okay. We are not interested in them. Number two, there are stocks that have broken the pivot, gone above the blue zone, and then came back into the blue zone or falling below the blue zone. Okay. Those are stocks where the breakout has failed. We are not interested in those stocks as well because we don't want to buy a stock that is falling down. We want to buy stocks that are going up. The third category is where the stock is very near to the pivot. It's either 1% less than 1% above the pivot or less than 1% below the pivot. It's almost at the pivot. So on the top right corner, nothing is written. By the way, for the second category, on the top right corner, there is red color because it might say it is minus 5% from the pivot, minus 10% from the pivot, minus 12% from the pivot. So the first category is mentioned in blue color, top right corner. We are not interested in them. The second category is mentioned in red color, top right corner, stocks which have fallen below the pivot. The third category is there is nothing written on the top right corner because the stock is at the pivot. And the fourth category is what we are interested in, where the stock is below the pivot point and it has a certain distance to travel till the pivot point. So maybe 5% to pivot, 10% to pivot, etc. That is mentioned in black color. So we are interested in the black color. Okay. So given this point in mind, my programmer friend suggested that I go to pattern recognition filter, scroll down, go to the last filter. It says percentage to pivot, which means there is a certain distance that the stock has to uh, travel to reach the pivot. Last close means latest close. Maybe it's referring to weekly and on the weekly time frame chart. So if I do this less than or equal to 20, then it should give me all the stocks which meet our criteria. Within those 89 stocks, I only want to see those stocks which are nearing the pivot, okay, and they are at a distance which is not more than 20% to pivot. So this will automatically reject the first category of stocks where the stock has already gone beyond the pivot. It might also reject the second category of stocks, the red ones, the stocks that have broken the pivot but came down. It could probably also reject stocks where there is nothing written on the top right hand corner, right? I don't know. See, I personally don't understand these filters. That is why I don't use them. I don't know how MarketSmith is interpreting these. I have not found any explanation for this on the MarketSmith website, or probably I have not searched enough. So anything that I do not understand, I don't use at all. If you notice, these filters are very easy to understand, very intuitive. This is not very easy to understand. For example, base status weekly, complete forming max out. What is the meaning of max out? I have no idea. Okay, if you know, please tell me. Okay, some of my students are way smarter than me. Okay, so if you are smarter than me, please enlighten me. Okay, please explain to me what this is all about. Maybe we can use this in our future videos or we can modify our system. Maybe there is some value in this, but I have not explored. Okay. It even gives us the name of the pattern. So this is fantastic. But I have not gone there. I am an old school guy. I like to do things manually. Right. So if I do this and I save the filter, I apply the filter, see 89 becomes 24. So a lot of time actually is getting saved. So it's a very good suggestion by my programmer friend. He told me not to mention his name, so that is why I cannot mention his name. But a very good idea given by him. However, I continue to discourage people from doing too much automation. One lesson that I have learned from my mentor, Mark Minervini, is that if you put too many filters, your filters become too restrictive and you might miss out on some great stocks. So that is why I keep my filters very broad. Okay. My filters are those things which are absolutely non negotiable. right? I mean, if the industry group rank is more than 100, it's absolutely non-negotiable. We don't want those stocks. Okay. If the relative strength itself is less than 70, we don't want to go near that stock, irrespective of how fundamentally great that company is. Okay. Now, there is one weakness in this strategy which I would like to discuss with you. Have a look at this cup with handle. Let's go to the next week: Monday, Tuesday, Wednesday, Thursday, Friday. Okay. Now look at this. Is this a proper breakout? Yes. Why? Because the stock has closed above the pivot point. Has it closed on high volume? Absolutely. The average volume is 12 million shares traded in the week, and the actual volume is roughly 24 million. So this is 100% of average weekly volume. So the stock has broken the pivot point with more than 100% of average weekly volume, right? That's a legitimate breakout. Okay. So you might end up buying shares in this week. Now have a look at this. This stock is probably closed 1 or 2% above the pivot point. Okay. And it is still inside the blue zone. Now, will this stock come in this filter? No, because this filter is only about those stocks which have a certain distance that they have to travel to reach the pivot. But this stock has not only reached the pivot, it has broken the pivot. That too cup with handle, which is a very predictable, very reliable pattern. It has broken the pivot point of the handle in the cup with handle. It has broken it on high volume, and the stock has closed inside the blue zone. And the stock is still buyable inside the blue zone because there is still maybe 2-3% distance it has to travel before it finally comes out of the blue zone, right? Now, if I move this forward next week, see, stock continues to go up. It probably attains the target of 20-25%. Let's see. So let's say you buy somewhere here, done, target is achieved. In 3 weeks, the stock has shot up 60%, right? So you can't miss such stocks. Will this stock come, like for example, here? Assuming you see this, will this stock come in this filter? No. The stock would probably come on Monday, Tuesday, Wednesday, maybe Thursday, Friday. It won't show up, right? When it actually breaches the pivot. I don't know. Okay, I am not sure when the stock will show up in the filter, when the stock will not show up in the filter. But I can tell you that at the close of this week, definitely the stock is not showing up in your filter, because that filter you're eliminating stocks which have crossed the pivot. Now imagine this: Monday, Tuesday, Wednesday, Thursday, Friday, the stock had a poor relative strength. By the time the week closes, the relative strength comes within more than 70 or probably goes to more than 80 during that week. So now the relative strength is doing well. So earlier the stock was not coming in your filter, maybe because of relative strength or maybe some other filter. Okay. But now that it has got good relative strength, will it come in your filter? No, right? That is the problem with too much automation. This is the reason why I actively discourage people from too much automation. Please do things manually. Okay, let us keep things manually. Open each of these stocks one by one in a new tab on your Chrome browser or your Safari browser. Okay, it takes only 1 or 2 seconds to reject a stock. So why to automate too much? Keep the filter broad, cast a wider net. If you want to catch fish, you have to cast a wider net. Okay, cast a wider net and then see which stocks are coming in that filter, and then manually see whether you are comfortable with the stock or not. One more thing I would like to say is that sometimes if a stock is good enough when it comes to fundamentals, I might end up buying this stock even though it has crossed above this blue zone. Now you might say, Rohit, what are you talking? That's impossible, right? You are violating your own rule. Well, of course, I'm violating my rule, but in extremely rare and exceptional cases, I might want to do that as well, because I know what risk I'm taking. I am buying an extended stock, of course, because it has crossed the blue zone. But if I know what I'm doing, if I pick up the stock beyond that blue shaded area, but I manage my risk on the daily time frame chart by keeping my stop loss at the latest candle low, maybe 2-3%, not more than that, and the stock continues to go up, I have not only increased my position size in the stock, but I have also controlled my risk. So there is no rule which says that which you cannot buy above the blue shaded area. You can buy, you can do whatever you want to do, but you have to do it with the awareness that you are taking way higher risk. Okay. So if you are mentally, emotionally prepared to take that risk, go ahead and take that risk. You should be aware that you are taking risk. But if you buy a stock above the blue shaded area without any perception or awareness of risk, that's a professional error. You don't know what you're doing. Okay. So sometimes I might violate my own rules to buy stocks, but that comes with experience, judgment, awareness of risk, my feel about the stock, and things like that. And in such cases, generally my stop loss is very tight because I know that you know, I know that I am taking a risk. See, basically, if you are jumping into a swimming pool, it is better to know the depth of that swimming pool before you jump into the swimming pool. If you jump into the swimming pool without even knowing the depth of the swimming pool, that is not professionalism. Okay. So that's the best example that I can give you. So automation is good if it is done in the right spirit and to save time, but automation should not come at the cost of losing great opportunities. Okay. You might automate things to a level where you start missing out on great stocks. A stock could be fundamentally great, but because of some very strict automation rules that you are using, the stock is not showing up in front of you, and you don't even know. You don't know that the stock is not showing up in your screen because the machine is taking care of everything. So if you want to do automation, keep your filters broad. Okay. Try to do things manually. Try to do automation after you have filtered the stocks. Okay. So on chart automation is fine, but using too much automation to filter is not great. Okay. So if you are a programmer, coder, you like to do things to save time, you do it. But also rely on human instinct, your gut feeling, because ultimately, when it comes to taking a position size in a stock, no machine can automate that, right? Your position size in a stock determines on a lot of factors. For example, you see a stock, I see a stock. Okay, we both like the stock. Liquidity, comparative, technical, fundamental, market. Your position size in the stock could be 10%. My position size in the stock could be 20%. Why? Because before you took the trade, maybe the previous three trades were loss making trades. And before I took the trade, maybe the previous three trades were profitable trades. So I can use that money to take additional risk on the next trade. So just because a stock is giving you a pattern does not mean that every trader should take the same position size. Same stock, same analysis, same everything. Two different traders should take two different position sizes depending on their risk appetite. Okay. So your decision to buy a stock will depend on what has happened in the past, what is happening in the present. Another example I will give you is if you decide not to do yoga today, let's say you do yoga every day. If you decide that you don't want to do yoga today, that does not mean that you are a lazy person. It could mean that in the past 10 days, you have been doing yoga every day without taking a break. That is why you are taking rest today. So your decision not to do yoga today depends on the what has happened in your yoga life in the previous 10 days, right? So your decision not to do yoga today is dependent on the previous 10 days. Not doing yoga today does not mean that you are a lazy person. Okay. If you have already eaten three mangoes, will you eat the fourth mango? Well, of course, if you are a mango fan, you will eat five mangoes, no problem. But in general, I am talking, if you have already eaten three mangoes, the fourth mango will not taste great, right? So your decision to eat the fourth mango will depend on how many mangoes you have eaten in the previous 1 hour or maybe 2 hours, right? Similarly, your decision to buy a stock should not be solely dependent on the liquidity, comparative, technical, fundamental, market analysis. That you have to do, that is non-negotiable. After you have done that, then when it comes to position size, you have to look at the past, your previous trades, your portfolio status, your portfolio position right now, the market condition, the overall feel. What if tomorrow they are announcing the election results? Right? What if tomorrow they are announcing general election results? Will you take a 25% position size? Will you take a 20% position size? Well, those are things you cannot automate. That is why I'm telling you, please do things manually. It will help you. And every day when you keep clicking on the same stock every day, that you become in tune with the market. You go into the zone. Okay, you get into the flow state. Just like meditation, you start meditation, you want to do meditation for an hour. After 20-30 minutes, you go into the zone. Okay, you go into the flow. You don't know what is happening around you. Okay, you go into a different world. Similarly, when you manually do things, you get into the flow of the market. Okay, you don't need to check the index to determine market conditions. Okay, so that was my little lecture on automation. I still recommend that you do things old school way. This is exactly the way William O'Neill used to trade back in the early and the late 60s. In those days, there were no computers at all. Imagine how he was doing things, and he was doing it successfully. So you really don't need to do automation. Okay, do it in the right spirit, but don't miss out on great opportunities. Thank you so much.